you don't know what the top or the bottom is. You're not going to time things perfectly.
Welcome to Wealthion. I'm Eric Chemi. November has historically been one of the best months of the year, the second best month, in fact, for U.S. equity markets. We've seen the same trend so far this year, a big pop up since Halloween. My guest today is here to discuss those moves. He's also going to show us the charts he's been looking at, the data points he's most concerned about. The big question, of course, will this November be one to remember? Jay Woods is my guest. He has spent over 25 years on the floor of the New York Stock Exchange. He's currently the chief global strategist for Freedom Capital Markets. Jay, you're also, if I'm right, CMT. Isn't that like a chartered certified market technician? It's something like that, right, Jay?
Chartered market technician. Yes, I've had my CMT designation for several years. I serve on their board of directors, and technical analysis has really helped me from a trading point of view, from a risk reward point, and now gives me a good perspective on what the markets are doing as well.
What are the markets doing right now? I know it's maybe crazy to ask. Could you even show us some of the charts you're looking at? Like what are you looking at? If you have an S&P 500 charts and show us how this is playing out.
Well, Eric, I'm glad you mentioned the charts. The S&P 500, I like to look at things from the top down, and it doesn't get any more macro than the S&P 500. So let's share my screen here on the S&P 500 chart. And what we're looking at is just over a year. We're looking from that October low in the bottom left corner to the 4,600 high, which now we have our targets on going back to the end of July.
Let's slow down here because there's a lot in this chart. And I'm going to need to bring the glasses in here pretty soon to take a look at this. So we've got this. Is this a 1 year chart?
So we're looking at going back to the October low. So it's 1 year daily plus 3 months to give you that October low to show you the trough to the peak, the nice run that the market has gone on. And then what happened once we peaked? We retraced. A lot of people were panicked once this market broke this, what we like to look at, this support line here, 4,200, the one vertical line going across the screen. I'm sorry, the horizontal line going across the screen. The market pulled back. The S&P 500 generally pulls back 10% on average every 18 months. So what did we have? We had a 12% correction from our July high down to our October 27th low. And then we rebounded. And how have we rebounded? That is what we're looking at. You talked about a November to remember as we kicked off the show. Well, what I'm seeing is we had a failed breakdown where we spent 6 days under this red line, the 200-day moving average. This is, it's not a line in the sand, but it gives you that barometer of whether the market's acting bullish or bearish. And when it breaks below a 200-day moving average, something may have changed. So if it spends a lot of time under that average, you've got to be concerned. So we were concerned coming into that last week of October as we broke down, but we quickly recaptured it. And not only did we recapture that average, we gapped up above it. We gapped to the 50-day moving average, and then we broke the intermediate downtrend where we had a series of higher lows going back to our peak, and we held up above 4,400, now 4,500. This is positive momentum, and the momentum is starting to broaden out, and that's what we like to see.
I'm looking at this breakdown around the Halloween time, right? We go back a few weeks where you said it was 6 days under that horizontal line of, it looks like around 4,200.
Correct.
How is somebody supposed to know when you've got the real breakdown? Because it's like, hey, you went under that support line. Now you're down, you're down, you're down. It suggests that it's going to keep going down. And then all of a sudden it flips back up. So how do we, as investors, as traders, try to look at these charts and say, okay, well, that line of support made sense, and then all of a sudden it didn't, right? And it was a head fake there. How
you're asking,
are we supposed to give it?
No, you're asking a perfect question because as technicians, we get a lot of grief for this because, oh, wait, it broke support. That means you should have sold it. It depends on a few factors. This is what we call the classic bear trap. So to explain what a bear trap is, it breaks a line of support and it looks like it's going to follow through, and then it doesn't. It quickly reverses. And when you get caught in a bear trap, it's not a good thing because the reverses tend to be very fast and furious in the other direction. So we did have what's called a bear trap. They are very difficult to predict. From a technical point of view, I look at it on multiple time frames. As a trader on the floor trading minute by minute by minute, I would have been short. I would have shorted this move and I would have tried to buy it as it, went under, and I probably would have held my short a little too long thinking this is it. This is the breakdown. These are the things I'm worried about. Okay, but we didn't have follow through. You need follow through. And what we had was a reversal about 3 days under it and then a retest. When you break a level of support and you go back up to it, it should be resistance. But in this case, it recaptured that level, recaptured it on good momentum, positive news, and then seasonal factors, which we talked about and you mentioned at the top of the show. November is the second strongest month of the year, December the third. So we know markets tend to bottom in October. In fact, the market is bottoming in October more than any other month by far. And that means just a reversal and then a trend, down 5%. And then a reversal when I talk about these bottoms to quantify it for you. But that is a very fair question. It's something as a technician we do get judged on a lot. Well, wait a second. It broke down. That should have been the end of the world. And yes, a short-term trader would have got caught. But what you have to do is you have to be nimble. You have to manage risk. And as a risk manager, job number 1, 2, and 3 of anyone trading in this market, it rallied back above it. You have to respect that trend, respect that change, and then adjust. And as soon as it broke back above the 200-day moving average, those shorts were covered. And this is what you see. This is where the momentum comes back in. Because a lot of these algorithms, a lot of the way people trade now, there's no hand-to-hand combat like I used to deal with down at the stock exchange. It's programmed. So when you break above a moving average or break below it, momentum tends to follow. And that's what we saw here. We saw a nice short squeeze, plus positive news economically, a Fed that is now pausing, and we tested other levels. So when you go back up, all right, well, maybe it will pause right here at this 43.50 level or at the 50-day moving average. It didn't. Maybe it will pause at this downtrend. There was a lot of levels where the downtrend could have continued. It didn't. Then you throw in the fundamental news behind what's driving this, plus the seasonal factors, and it's very difficult to be bearish for the next 6 to 8 weeks easily. And if we were to forecast it out, my eyes right now for year end are at this 4607 level, which is the 52-week high. And, given the stocks that are driving this market and now the broad-based rally we're seeing with the Russell participating, it wouldn't shock me to see not only us test those 52-week highs, but us break them by the end of the year. And we're talking, 5-6 weeks now?
So this is all very good. And I've got so many more questions on this, right? Because
please,
let's go back to February where we saw the 50-day moving average, that's in blue, cross with the 200-day moving average in red. And then I forget there's the death cross and golden cross, and this, what is that cross, and what did that mean for us here? Because it did actually happen right at that sort of local maximum at that 4,200 level there in February.
Yeah. So, and by the way, congrats to you, you nailed it. A golden cross is a bullish crossover when the blue line, the 50-day moving average, crosses above the 200-day moving average, the red line. So we had what we call a golden cross. Now, if you were to trade that golden cross, it's a lagging indicator. It is great for long-term investors over time, especially golden crosses. And then you have the fear of what happens if the 50-day goes below the 200-day. That is called the death cross. That is generally a sell signal, especially over time. But that also is a lagging indicator, because if you're waiting for this 50-day moving average to go below the 200, you're still long this market and you've been holding since 4,600. if the market does turn, you're going to miss out a large portion of it. For the long-term investors using those indicators, they do work, but you'll miss a large chunk of the trade. But the good news is for a bullish trader, the golden crosses, once you buy those golden crosses and you sell a death cross, you're generally getting about 70% on average of the meat of that trade. So the risk reward setup is good, but the timing is a little laggy. So I'll use other momentum indicators, and I don't want to, go too deep in the weeds here, as far as RSI and MACD crossovers. I just want to keep this simple because this simple chart really does tell the story. And you were very, astute to see that we had something change here. And then let's look what happened after February. It came back, it retested the 200-day moving average from above, and it spent about 6 days, 6 closes below that average, and then it rallied. And guess what? We spent 6 closes below that average this time, and we're rallying again. So the momentum, given seasonal factors, given, the low bar for the earnings, there are a lot of positive signs, plus the Fed is on pause for the foreseeable future, that this market can continue to go.
So it's interesting. I'm still looking at that cross. That looks like you're saying a golden cross where the short-term moving average went above the long-term one. But if you had bought right then and there, you would have lost 10% in the next 2 months.
Yes. Yeah. Like I said, it's a lagging indicator. It's for the long-term trend. And those averages are just a barometer. To me, they tell you the health of the overall market. And once it goes above or below, you have to kind of say, okay, something's changed. What's the significance? And that's where the fundamentals come in. I don't just, look at price and say it's going higher, it's going lower. I know what's going on in the world. We follow the 10-year very closely because the 10-year has been driving that bus. In fact, if you want to look at a chart in the 10-year, I'd gladly pull it up for you.
Let's do it. Let's do it next. My last question, bring that back, because this is the S&P one is so key, right? So let's just look at that here for another second. If you're able to bring it back up, hopefully.
There we go. Do you see it now?
There we go. Are you able to draw a line? And we're going to get to all this. We have plenty of time, right?
Okay.
Are you able to draw the line from the lows, like that 34.91 low? Then you see it was a 38.08 in March. Are we able to see kind of that upward diagonal trend? Because I'm curious if all of a sudden that's going to break down on us at some point. Like,
well, it actually did break down on a longer term basis. And you can see right in this area here, when we broke down pretty aggressively. And that's where a lot of people got spooked. Now, when did we break down? We broke down in the seasonally weak September period, and we had that 4,200 level in sight. So at that point in time, targets were, it's going to test the 200-day moving average, and let's see if it holds. It also is a major Fibonacci retracement level. I know a little too deep in the weeds, but from the low in October to the high in August, and it just quickly tested it and rebounded so quickly that you had to be very nimble in your trading. And then if you want to back it out over a long period of term, when, as a technician, when in doubt, we have an expression, when in doubt, back it out.
And can you back it out for us?
There we can back it out.
Because I'm looking at that trend line that you showed, the upward trend line. And even though we've popped back up recently, it almost looks like it's going to hit that line again as resistance on that upward diagonal. So I'm looking at this, and to me, it feels like this is a bearish chart, but maybe I'm not understanding this.
Okay.
So
well, I'll tell you why it's not bearish, because of this gap on the right-hand side and the breakout of the long-term downtrend. That's why it's not bearish to me. But let's, when in doubt, let's back it out. So what I'm going to do is I'm going to go to a 5-year weekly chart, and that gives you, it takes out the noise of the days. You want to look at a longer term weekly chart. Now, I don't know if you can see this on your screen, but what did we do? We just changed.
See as you're filling out, weekly, and then here's the longer. By the way, what system is this? Stock Charts?
I use Stock Charts. Yeah, they're good friends of mine, and they've been very, very good to me. And their charts to me are very crisp. I don't know how it plays through on this broadcast, but to me, on the weekly chart, you can see this red line at the bottom. And what I'm seeing in that red line is the 200 weekly moving average. Now, we have that COVID drop where it went below
Right.
it for a quick period of time and it quickly regained it. So for the longer term investor, for the person that's not watching the market every day, I watch every tick, every minute of every day. It's not a fun way to live. But when I talk about my own retirement funds, I don't look at them every day. I know I put them in the index. I pick some of the stocks that I feel are the best place stocks within different sectors. And then I set it and I forget it. And in the S&P 500, if we want to go back 5 years on a weekly basis, all right, we had the COVID low, we retraced, we got back on a nice V-shaped recovery, and we continued on a nice uptrend. It got a little too accelerated, but what I see here now is a nice little rounded bottom. So we tested 200 weekly moving average. It held. We're back above the 50 week, and we broke the intermediate term downtrend, and we're probably, and I'm very confident, we'll go to this 4607 level, which is the 52-week high, and then we may pause, and that's fine. Markets don't go straight up and don't go straight down for an extended period of time. Yes, you have outlying days. We just had 10 straight days of Nvidia going up. We had 15 straight days of Tesla going up earlier in the year. But over time, they will trend, and the trend continues to be fighting to go higher. We're still not at this 4,800 level where we peaked on the first day of trading in January 2022. But if this momentum continues, maybe we peak right back there the first day of January 2024, and we go round trip in 2 years. So we're trying to fight back to where we were just 2 years ago if you put it in a bigger perspective.
Can you run a chart for me? Almost like, can you cut off all of 22 and 23? It's almost like keep what you have here, but end it at the 48.18. End it on Jan 1, 2022.
No, that gets a little confusing for me. So you want me to end it? I see what you want.
It's more like if we didn't know what the last 2 years were, could we have predicted it from what we knew up to that point? Because when I'm looking at 48.18,
yes,
obviously hindsight's 2020. We know that it peaked there and it went down. But if I was standing on that day, trading on that day, we wouldn't know this is the top, right? So
you never
do.
do.
We know?
And that's a great question, and I get that as well. You don't know what the top or the bottom is. You're not going to time things perfectly. And we all want to, when I buy a stock and it ticks down 10 minutes later, I'm upset. But I didn't buy it for 10 minutes later. I bought it for a longer term. What I look for, if things get overbought, like the index was at 4,800 because it went on a tremendous run, or oversold or reached levels, then I dip in. I don't go all into a trade, but I'm never going to catch that top. I'm never going to catch that bottom. And people in this industry say, I nailed the market there. I nailed them. No, but if you managed your risk accordingly, you're going to ease out of a trade because you got the meat of it here. And then where I did get out was when it broke this 50-week moving average. Something had changed. And then the trend had changed. So you get out, you reevaluate, because you don't have to just trade the S&P 500. You look at every sector within the stock, within the index. This last leg has been driven on 7 stocks. We need this S&P to make all-time new highs, not just to ride the back of 7 stocks, but to broaden out. And that is what I'm starting to see now. And that's what gets me a little positive, because as rates have started to come in, the broadening is starting to continue. Now, I think we're higher for longer. It's not going to be a straight shot up. We should churn sideways for a little while. But to answer your question, you don't have the price history. The history gives us a guide, because it's market behavior in price form. It's my emotion, your emotion to work in the form of price. It's the only thing that is factual when you talk about earnings. Earnings are estimates, but the way price reacts to those earnings is what I judge. That's human behavior in market form, right there on a chart. And if something changes, meaning we break down through a certain level, or a momentum indicator indicates, all right, we're not going up as aggressively as we did on this last move, then I adapt. I'm not going to be a perma bull or a perma bear. I look at things 3 to 6 months in my current role as a market strategist. As a trader, we could go deep in the weeds on volume weighted average price movement and, intraday swings. But for the long-term investor, and that's what I hope most people that watch Wealthion are, they're here for the long term. They're here to learn because that's what your platform does. And we can talk about the next few weeks, the next few months gladly. But I like that you raised the simple question, well, how do I know it's the top? You don't, but you are acting accordingly. If you have a profit, start the leg out of it and take some of that profit off the table.
That was going to be my question. Is we hear advice from people that say, look, when things are making new highs, that's because someone smarter than you knows that this is an opportunity to buy. And I've heard the opposite from people say, well, you should be selling when things are making new highs. So I still haven't figured out what is the right approach. Is it, on the flip side, when things are crashing down, hey, these are cheap. But others would say they're crashing down for a reason, right? Like smart people are dumping this junk and you don't want to step in front of it and catch it. So is it really you should be buying lows or you should be selling lows? Like this is the thing, because you don't know, like we said, you didn't know on Jan 1, 2022, you didn't know that was the top, right? But you might say, hey, we've had 2 years of positive momentum. Let's jump in now, right? How do you know?
Yeah, and like I go back, risk management. I don't know what the low is, and yes, it is better as a trader to buy stocks that are making new highs. And it sounds ridiculous. Well, it's at an all-time high. Why am I buying it? Because highs beget new highs, and we can see it in this trend. All right, it broke above the old COVID, pre-COVID highs, and it churned, and then we went on a nice leg. All right, I didn't sell the top, but I got in when that momentum changed and I rode it on the way up. But no, taking profits is the smartest thing you can do. The biggest complaint any trader can have is I sold it too soon. And, we all have stories. I can tell you about buying the Google IPO and making 50% and being really proud of myself because I made 50% in that trade. And then I look back 15 years later and I live in this small house. I could have lived in 3 houses if I held on to that stock. It's all about what your goals are, what your time frame is. And I like to trade the momentum, and the technicals give me that momentum on the way up. Now on the way down, yeah, it's tough. It's tough to pick a bottom. They always say in our world, never try to catch a falling knife. And we've seen it. And I've used the example of Disney. Disney is a stock that I bought for my daughter when she was born. That daughter is now 19 years old. But I bought it because it was something I knew, something I believed in, something I loved and used every single day. I mean, when didn't we have a Disney movie on in the Woods household? The answer was we always did. So let's just, we're going to generalize. I'm going to just show you a downtrend. Let me just move my screen up here. And I appreciate the audience's patience here. This is the longest term downtrend what we've seen over 2 years. All right. It makes a series of lower lows and lower highs. And as we get back into these volume bars, we continue to make lower lows, but it started consolidating. Every time it got below 80, it held. And that to me was a big change. It used this blue line, the 50-day moving average. It used it as kind of a line in the sand, a little resistance. It broke above it. I went out and I made a call based on the fact that some good technical things were changing. You have a new CEO that's familiar with the company, finally in there for over a year, and he's going to stay there a little longer, and Mr. Iger. And I saw a series of higher lows here recently going into earnings. So to me, risk reward setup was actually bullish. It favored the bulls. If it broke below 78, I get out, I take a little loss. You cannot be afraid to take little losses. The oldest thing I learned when I started as a trader on the floor, 4 things can happen when you get into a trade. You can make a little bit of money, you can lose a little bit of money. And those are usually what happens in every trade. The goal is to make a lot of money. And when you have that good trade, you let it ride, but you take profits along the way. And then you can lose a lot of money. You can't afford that one thing to happen to you because you don't have the money to replenish and make it up. Because if a stock goes down 50%, you need a 100% rally for yourself to make that money back if you put it all in at one point. But Disney, to me, it had the ability to mean revert, which would be just getting back to its 200-day moving average, which it did. It gapped above it. So it was there. It was on some strength. It had nice volume because the news, the earnings. So right now, I would take profits if I listened to myself back when it was trading 80.82. Full disclosure, I own it long term. I never got out of it, and I did not trade this. But for customers that I talk to, for clients, the risk reward setup was too good not to share that idea. We saw it with Nike, the earnings cycle before, and then we saw it with Target this cycle. So I can just punch up real quick, just give you another example.
Yeah, let's see. And while you're pulling it up,
Mm-hmm.
how much should people put stock into the charts, right? How much, you know, and we've heard different people say, oh, the charts don't matter. It's all about fundamentals. We know people that they don't even know what the company does. They don't even know the fundamentals. They are just looking at charts because they say, this is human psychology. This is human behavior. And these patterns are reflective of psychological moves, of how people deal with greed and fear and risk and reward and all that. So where do you find yourself on the spectrum in terms of the religion of the charting?
Well, full disclosure, as when I was in the private sector for 3 months on a garden leave, I became that day trader who was trading stocks that I didn't even know what they did. I saw a symbol, I saw a pattern, I saw swings, and I'd be in, I'd be out. So those aggressive day traders that may be watching, they know if they're following the technicals, they can see momentum, they can see patterns, they can hear chatter. That's something that I never got to listen to being on the floor of the exchange. We were just glued to our screens. But what is the first thing anyone does when they ask you about a stock you don't know? I punch up the symbol and I look at the chart, because the chart tells you a story. It tells you whether the stock's going up or going down, and then you can see gaps in the chart itself. Like, let's go back another year in Target, and I'm going to show you some major gaps.
So this is Target, Jay?
This is Target. So this is Target on a 2-year daily chart, just to let you know. And what happened you see this giant gap to the left of the screen with a huge spike in volume? All right. Yeah, you're not going to see that coming as a technician, but you're going to want to react to it. It's going to tell you a story. It tells you they missed earnings and they guided really poorly. And what happened? It took that drop and it stayed below this gap. Still, I mean, we're going back a year and a half. It has not filled that gap. And then it went sideways for a while, good volatile action. So the daily, the weekly traders could have traded the stock, had a little floor involved around the 100. Now I really have to squint to see this 120 level. And then it broke down again. It broke down here on another earnings spike, and it is at a new level. What we see are cycles of about 3 months, which is a quarter. Once the earnings, which is generally the biggest catalyst for a move in the stock, that will be what moves it up or down. I don't like to trade earnings, but I anticipate it. And if it looks like it's moving up into earnings, then something may be actionable. And what we saw in Target here, very similar to Disney, a double low, a long-term downtrend, a company that's been beaten down, and we saw Walmart making 52-week highs. Walmart had a better quarter than Target, in my opinion, if you're looking at the fundamentals, but their guidance was a little tepid. Target, they beat finally, and there's some positivity to it, and investors rushed into it. It's still in a long-term downtrend, but this move is a mean reversion in a longer-term downtrend. It broke and gapped above the 50-day moving average, and now it's pausing. Where is it pausing? In this area of consolidation where it traded 2 quarters ago, and at this 200-day moving average, which is declining. So it gives you these levels that set you up from a risk-reward point of view. I am never catching the top and catching the bottom. If I am, then I'm lucky. I just want to know that my risk-reward is favorable to enter the trade that I'm entering.
What right now is the current most relevant chart that you're looking at? It could be treasuries, it could be Fed, it could be macro. What is the number one? You wake up in the morning, this is the chart that I need to focus on and look at.
Well, that chart has changed. It would have been the 10-year. It was the 10-year in that 5% level. As the 10-year rose, the Russell went down. The inversion was great. The dollar has been a strong driver. I'm watching to see if that breaks down. But as we're airing this on Tuesday, there's one chart that matters, and that is Nvidia. And I'll tell you why. Let's go to the chart, shall we?
Nvidia, a single company, just a
A
single
single
company.
company. It sounds insane, doesn't it? Let's look at it. Why is Nvidia so important? Nvidia is one of the Magnificent Seven. It is up 240% year to date. It is accounted single-handedly for a 15% move to the upside in the S&P 500. Three stocks, Microsoft, Apple, and Nvidia, their gains alone this year are 50% of the S&P 500's gains. Plus, it's a leader in the semiconductor index. It's a tech leader. And, you know, if AI is the future, I want to hear what they have to say. Yes, I'm listening for the fundamentals because the price action has been very interesting. And this is one that scared me to death as a technician at the end of October. If you are looking at this blue line was support around $400. What I'm looking at Nvidia is after that big gap up we had in June, you can see it right here with this big volume surge. This gap, the stock has never turned back. That was a solid earnings report. We had another solid earnings report here at our peak at 502. They guided higher. They were looking strong. It already had a tremendous run, but something changed on this black candle at 502.62 on their last earnings call. It opened towards the high of the day, and then it reversed. And that reversal to me was, telling because price action momentum stopped going up. And now we had a ceiling in the stock. And then it turned down. Where did it turn down to? It turned down to this $400 area, and it rallied. It didn't make a new high. It had what we call in the industry a head and shoulders top. It had a left shoulder with a lower high, a head which is at the height, and then when it came back, it made a right shoulder with a lower high as well. We have this blue line here, which is the support in that head and shoulders pattern, which we call the neckline. If that stock broke 400 and closed below 400, I was ready. I had the towel in my hand that day, Eric. It was trading at 392 and it reversed and it rallied and it closed above 400. It was like it was there to be broken in. You want to throw in the towel, but you got to wait for that close. You got to wait for confirmation. We didn't get it. And that little line under support reversed and it closed back above it. And then when did this happen? Happened at the very end of October, and then the market turned, and Nvidia was up for 10 straight days, and not just 10 straight up a fraction of a percent. It went on a run. It was up 20% from 400 to 500 in just 12 trading days. 11 out of 12 it was up, and now it's consolidating, and it's pausing at that ceiling. It's not ready to make a new high. It's waiting for the next catalyst.
Just a dumb basic question. You see this chart, it's been range bound 400, 500, 400, 500, 400, 500.
Mm-hmm.
At 500, you're at this top. Are you just knowing nothing? Are you more likely to sell that top or buy that, high? What do you do in these? It's like, are we buying the momentum or are we selling the end of a trade?
I would be selling the end of the trade and lightening up going into earnings. That's just my personal preference. There are technicians that will be like, this is the time. It's testing it again, and they believe the momentum going into the end of the year. For me, I am not as aggressive as some of the people in my industry. But what I would do is if it gaps up, and it can stay up above the 502 level on an earnings call, I would buy that. And I would buy it and hold on to it until it gets back to that gap as a stop. And I would raise my stop. So for those that don't understand, once you enter in a trade and you're right, you can have a trailing stop. So if it gaps and it opens at, say, 515 on Wednesday morning, and that is where I entered, and it continues higher, I will say if it gets back to 515, I'm out. I took a shot. I broke even. It triggers a sell order, and I sell it for a little bit of a loss or a break even. But as the stock moves higher, the trader in me will move my stop higher. It's at 520. I want to guarantee a 3-point gain. I'll move my stop up to 518. If it comes in, it's a trailing stop. But from a longer term perspective, and this is what I really want to focus on, is you have a nice measured area of 100 points here from 400 to 500 over about a 6-month time frame. If this breaks out above it, given the AI story, given the momentum in the sector, given the momentum we've seen in this stock historically, I think a $600 price target over the next 3 months would be very, very
reasonable.
Thank you. Thank you for helping me out. Basic SAT words are failing me right now.
Can you
But
show us
mhm.
a longer term chart of this Nvidia? Because Nvidia's
Oh,
just
we
got
sure
so much.
can.
Can you show us a 5 or
So
10 year?
yeah, let's now give me 1 second. Okay. I'm just going to reset the whole thing.
And while you're pulling up that longer term
Yeah.
chart, how much has the trading game changed with the technicals when it's become so much more the computers, the bots, the algos, the trend chasing AI that are doing a lot of these trades? Has that changed the way you approach these technical charts, or does it still remain the same when humans are less involved?
The charts are always going to be the charts. There are more people with access to it, more indicators that will look for different momentum swings in stocks than we've ever seen before. And everyone is coming up with something new. AI is tapped into the technical industry, and they're looking for any triggers, any gap that they want to buy, any turn below a specific average. There are all sorts of ways that AI and the people basically programming it, other technicians, are going to try to get an edge on the market. So what has changed to me the most over 30 years in the industry is the speed at which things move. When you're going hand to hand and actually physically seeing the people and looking in their eye, and then manually entering those trades, it took time, and trades didn't happen at the speed with which you see. But news is instantaneous. Rumors circulate bigger and better than they ever have before. So you always have to make sure as a trader you have limits. Use limits. Do not use markets. Try to have a limit to your price so you know exactly where you're buying, where you're selling it. Use stop orders. Use them wisely to limit and manage that risk. But as far as how the charts tell the story, that has not changed. The charts go back in time, and you can see just the basic trends. And what we like to do is we like to go back in time because, price doesn't always repeat, but it certainly rhymes. And we see patterns evolve over time. What I've seen in the last 2 years, if you look at the S&P 500, we're pretty much below where we were 2 years ago, and we're working our way back.
We looked at that, right? Jan 1, 2022
22
was the top there. Yeah.
Mm-hmm. And now we're getting back there. So what happens if we eclipse it? Well, historically, we have a 2-year base of, a nice wide range, and we should see a rally continue. So to me, that means something has changed. But I look at Nvidia. You asked me to punch it up. This is 5 years on a daily basis. And what really stands out is that gap on the right-hand side of the screen on that earnings. This peak here going back to basically the top of January 2022. 2022 was a disastrous year for the Magnificent Seven, for these stocks that led us in 2021. We've just recouped them. In NVIDIA's case, we gapped above it, and now we found a new level of consolidation where if, the future looks bright for 2025, we're about to get that leg up, and we can start to see that uptrend over the long term continue. So to me, this is a very fascinating report, and there are definite levels to which you can participate. So at this point, it's a coin flip whether or not it breaks out or breaks down. The fundamentals will dictate that, and I will react to the fundamental news. As a long-term investor, I always say the Warren Buffett approach, the Peter Lynch approach, buy what you know, buy what you use, buy what you believe in. And Nvidia is a company that fundamentally, it fits that characteristic for me. It is the main player in AI. Microsoft, another strong player in AI. And these are companies, ironically, right at 52-week, right at all-time new highs. I think this story, as a guy like Dan Ives from Wedbush and Tom Lee like to go on the big networks and say it's early innings for this tech cycle. And when I look at the charts, I can see why they're saying it, because they just broke out to 52-week highs. They just broke out to all-time highs. And positive earnings, positive guidance, and you're going to see the stocks trade higher for another 3, 6, 12 months. And that's good for another 20 to 30% to the upside. And that's a conservative call.
What about that gap that we saw there 6 months ago? It's obvious on this chart, right? It's a big gap. And I've heard the theory that all gaps have to be filled at some point. So that suggests a massive downturn here in Nvidia is still to come that we're waiting for.
Well, all gaps must fill. That is actually on the CMT level 1 exam. Do all gaps fill? True or false? The answer is actually false. You have a series of gaps. You have the breakaway gap, and that's what we see here. This was a breakaway gap. It was right at an all-time high. It broke out. There's your breakaway gap. Then you had a couple gaps in between. They backfilled. Those are your common gaps. And then you have what's called an exhaustion gap. And that's what we saw on the last earnings cycle when it gapped up 20 points on the opening and then it filled. So there was really no gap on a daily chart. There was no gap on a weekly chart. But if you followed it tick by tick, you followed it day by day, it gapped 20 points and it filled. To me, that was a near-term exhaustion gap that did fill, and it said, all right, something has changed. Now, this big gap here, it could fill. There's no doubt about it. And that's why I got so nervous come October 27th when it was back down below 400. And you were like, all right, as a technician, this is not good. If it continues on its downward trajectory, it's going to fill that gap. And you had a measured downside. Thankfully, it didn't get there, but I was looking at that very carefully.
If you can you pull up a chart of a 10-year bond or whatever the yields were that you were looking at? My guess is it was the 10 and not the 2 or the 30 or something like that.
You're correct. It was the 10-year, and I'm going to pull that up for you now. Let me just see if I can share that on the screen.
Although before we go, maybe before you share your screen, we keep mentioning the Magnificent Seven. So let's remind our viewers. I know Definitely. It's Microsoft, Apple, Nvidia. I think Tesla's in there. It's Facebook, Google.
Yeah, that's one more. You probably have a package outside your front door from them right now. There you go, Amazon.
So let's go to Microsoft, Apple. So Microsoft, Apple, Nvidia. We did those three.
Those are the biggest three this year, too. So that's 50% of the S&P 500 gains right there.
We got our Facebook and Google, our social media play.
Correct.
And we got Tesla and Amazon. Okay.
Tesla and your consumer discretionary plays. That's exactly what you have. And those have been the leaders. And I watched Tesla. Tesla's got me a little concerned right now. That may be falling out, and it may be just a sweet 6, or we can come up with a cool name.
Pull it up real fast, Tesla, before we get to that 10-year.
Okay, let's go to that then. Share.
Since you mentioned that you were concerned.
One, let's talk fundamentals. Their earnings, as Dan Ives, I mentioned him once before. I'll mention him again. He came out and said it was the worst conference call he's heard in their history. Okay, that's not good. But what do I see in Tesla? I see a series of lower highs. I see a breakdown below key moving averages. It gapped lower on its earnings. Okay, let's.
Is this a 1-year chart? I can't see.
This is just. Yeah, this is a 1 year, and I'm going to give you a much better look at it in a second. Here we go. This is the 1 year, and what you can see is the blue line, the 50-day moving average. It broke below that, and now it gapped lower. That gap lower was on earnings. It continued to make lower highs going into earnings. It was what we call coiling, where you had an uptrend and a downtrend converging, and it broke the 50-day moving average the day before earnings, which was very interesting to me because usually you wait for the earnings. The price was telling us something isn't right as it went into earnings day, and then the earnings confirmed price action the next day with the gap down. It broke below the 200-day moving average. It flirted with it for a little while, and now it's stuck between a declining 50-day moving average and a rising 200-day moving average. This stock is not in a healthy uptrend right now. What we like to think is consolidating, and maybe it will be setting itself up after another good quarter of earnings. But for the next 3 months from its last earnings, so another 6 weeks until its earnings come out then, the stock to me is a don't touch. And, there are better places to play. So I like to go where the momentum is. And that momentum continues to be Microsoft. It's Amazon as well. And we're now starting to see some mean reversion in some of the smaller caps as well.
Okay, so that's good on the Tesla side. A don't touch stock from Jay. Now let's pull up that 10-year bond yield.
Yeah, let's go to the 10 years. So let me stop sharing for a second here, and
And that'll be our last chart of the day, because I know you've got some trading to do, and we
yeah.
spent a lot of good quality time here. But I
Well,
do want to look at that 10-year, because you said it was the number one thing you were looking at up until very recently.
exactly. So here we have the 10-year, and we look at the moving averages first. The moving
What
average
is
is the
this number
barometer.
though? What is this
What
44.50? What is this?
44.50 is the last sale. We're looking at the right-hand side. 44, so it's at 4.45%.
So it's the yield times 10.
It's the yield times 10. Exactly.
Okay.
So,
Okay.
yes, and I love that you simplified and slow me down, because I can, as a trader, talk
I was
extremely
like,
quickly.
I don't think the 10-year is at 44% or $44. So I'm
No,
trying to figure out what
it's
that is. Yeah.
4.45% as we tape this. And what we saw was a sizable rally from the lows here back in May up until the peak here in October. And it's the speed of the move, because rates don't tend to move very quickly. For a move like this, historically, it doesn't happen too often. And when things go quickly, you have an inverse reaction where you saw utilities and high dividend yielding stocks, real estate stocks, staples. They were all in deep downtrends. While this rallied well over 20%, the staples were down 20%. And now they've found a bottom. Where did they find a bottom? When we peaked out. Once the 10-year got to 5%, it struggled to get back above it. And then all of a sudden we broke down. And what was that breakdown? That breakdown was the FOMC meeting. That was the dovish pivot, if you will. I'm not sure what we're officially calling it, but it was basically affirming the pause, waiting for more data points, and assessing there will be no December rate hike. And now we took another leg lower. We broke a rising 50-day moving average in the index itself, and we're making lower lows. This is positive. So we had a gap up. Now, in this case, we hope this gap fills. If you're long stocks, we had a gap up, and it rallied. It stayed above it until recently. Now we're testing that gap going back to the early summer. And if it continues to retrace, this is positive for stocks, growth stocks in particular, small caps as well. So what I'm watching is
As in you want yields to go lower so the growth stocks can go higher.
Correct. And then you'll see more companies hopefully test the IPO market. You may see more deals. This is very bullish if we can get to a more reasonable level. Now, this is still, historically going back, a decade, historically high, but the market is taking it in stride. And once they see the trend change like it has, we are no longer going up. We've broken some support levels on this uptrend, which was the 50-day moving average. If it can continue to decrease, this is very bullish over the next 2-3 months. And it fits right into the narratives we talked about in the beginning of the show. Your seasonals, your November, your December strength, from November to April, 6 strongest months of the year. April is actually the strongest month of the year. So the way we're ending this year, as rates are starting to decline, if that path can continue, and I suspect it will at most stay at these levels, at best decrease, and we may be talking 4.25%, maybe even 4%, if it continues to work its way down to its 200-day moving average. So there are positive developments, because as the 10-year goes down, the S&P goes up, the Russell goes up, and that's been the most beaten down index. It was up 5% last week, and it's up for the year now. So things are ending 2023 on a positive note. So the indexes themselves, they're changing. The stocks that make up those indexes, the Microsofts, the Apples, making 52-week highs, and now we watch Nvidia to see if it can continue to join that party. And if Nvidia goes well, then watch for tech to be lifted on its shoulders as well. It's going to be exciting to watch Wednesday at the opening, and that price action going into Thanksgiving.
Jay, thank you so much. This has been really fascinating to walk through your charts, the way you're looking at them, some of the breakdowns, what you like, what you don't like, what you would stay away from. I really appreciate it. And yeah, we're going to have to see how the rest of the month and the rest of the year plays out here.
Hey, Eric, I appreciate this forum, and I thank you for slowing me down, because sometimes I go on, I can get too excited when it comes to these charts. And, I think it's important. And you gave a great picture of, you're not going to sell the high, you're not going to buy the low, but you have to remember to manage the risk. And those charts are basically setting you up. And also, know your time frame. If you're short term, then we can go deeper in the weeds and look for more pivot points. But I think for the long term investor, you helped me paint a nice picture, and I'm happy to join you. And I'll come back anytime you want.
Where can people find you? Are you doing a newsletter or social media? Where's all the Jay Woods info out there?
Okay, well, you can follow me on Twitter at JWoods3. And the pinned tweet is a link to my newsletter at Freedom Capital Markets. I put out a weekly newsletter where we focus on, guess what we focused on this week? We focused on Nvidia. We focus on the 3 charts that are really going to move the markets, make the most news. We'll do a macro look at what, indexes are moving the market. Generally, we'll look at the S&P 500. Last week, it was the Russell as well, because that's starting to move. And it gives you just a general recap of things we're watching and what to look out for from a week-to-week basis.
Very cool. Jay Woods, once again, Chief Global Strategist for Freedom Capital Markets. Thank you so much for joining us. And, for those watching, if you're looking at this thinking, I'm not sure if I'm going to be able to figure this out on my own, I need a professional to help me, maybe an investment advisor, wealth manager, RIA, whatever you're looking for, consider a free consultation. Consider going to Wealthion.com. You can fill out the short form there. There are investment professionals that Wealthion endorses that we can connect you with. So it's super easy, super short form. It's free, no obligation. There's no commitment. You can just talk to them, see if you like them. And if you don't worry about it. So we do offer that as a free service, trying to help people who want to get educated, want to have more power over their family's finances. This is one opportunity to do that. And once again, if you like this video, like I certainly love this one with Jay Woods and I, like it, subscribe, forward it, share it, tell your friends. This is how more people can watch the content, hear the content, and get access to it. So thanks again for watching Wealthion with Jay Woods. I'm Eric Chemi. We'll see you next time.